Imagine you are the CEO of a community bank. You handle deposits, loans, payments, regulatory filings. And every single one of those transactions runs through software you did not build. You do not own it. You rent it. From a company most Americans have never heard of. A company that just had its best new business quarter in 7 years. This is the story of Jack Henry & Associates, and why ripping it out of your bank could take multiple years and cost 9 figures. Jack Henry serves more than 7,500 community banks and credit unions across the United States. That is almost every regional and local lender you have ever walked into. The branch on Main Street, the credit union that financed your first car, the community bank that knows your kids' names. Behind the counter, the same Missouri-based software vendor is quietly running the show. Here is what people miss about banks. A bank is not really a building, it is a database. Every transaction, every loan, every ACH transfer, every debit card swipe, every regulatory report, all of it gets routed, recorded, and reconciled by something called a core banking system. There are only 3 major providers in the country: Fiserv, FIS, and Jack Henry. Together, those 3 companies serve roughly 75% of American banks. It is one of the most consequential oligopolies almost nobody talks about. Roughly 91% of Jack Henry's revenue is recurring, not project work, not one-time licenses. Subscriptions, processing fees, and hosting contracts that renew on 6-year terms. The bank pays whether it makes a loan or not, whether the economy booms or busts. The toll booth collects regardless. Look at the revenue line: $1.75 billion in fiscal 2021, $2.375 billion in fiscal 2025, up 7.2% in the latest year alone. No glamorous product launches, no moonshot acquisitions, just the same software, billed to slightly more banks at slightly higher prices every single quarter. This is what compounding actually looks like when you strip away the noise. And here is the number that matters most: 99%. That is, Jack Henry's annual core client retention rate, excluding banks lost to mergers and acquisitions. When a community bank signs up to run its core systems on Jack Henry, it almost never leaves. Not because the contract is ironclad, because leaving is functionally impossible. This is the quiet monopoly thesis, and Jack Henry is the textbook case. The most durable businesses in the world do not grow by being loud or trendy or culturally relevant. They grow by becoming load-bearing infrastructure. Once they are embedded, ripping them out costs more than tolerating them. That is why we obsess over toll booths and ignore unicorns. The unicorn might quadruple your money in a year. The toll booth quietly compounds for decades while you are not looking. Jack Henry is a boring Midwestern software vendor with no consumer brand, no viral product, and no CEO on magazine covers. And it has spent decades becoming nearly impossible to fire. Want proof of how sticky this really is? In the first quarter of fiscal 2025, a $17 billion asset bank that had already issued Jack Henry a formal contract termination notice quietly reversed its decision. It re-signed for 7 more years. Think about that sequence. The bank's board approved an exit. Lawyers sent the notice. Then someone ran the numbers on what it would actually cost to migrate every account, every loan, every regulatory feed onto a new platform. The decision flipped. That is what an infinite switching cost looks like in the wild. Now look at what is happening on offense. In the quarter ending March 2025, Jack Henry booked 17 competitive core wins, the strongest single quarter result in 7 years. 5 of those new clients had more than $1 billion in assets each. The quarter before that, 11 more wins, including a $7.5 billion institution. Jack Henry is not just defending its existing toll booth, it is buying new ones at the top of its market from its biggest competitors. And the profits are accelerating, not slowing down. Net income climbed from $311 million in fiscal 2021 to $455.7 million in fiscal 2025. That is a 19.3% jump in the latest year alone. Diluted earnings per share went from $5.23 to $6.24 in a single year. Operating income grew 16.2%. This is what happens when subscription pricing meets a captive customer base. And the balance sheet? Zero. Jack Henry paid off all $150 million of credit facility debt that was outstanding a year earlier. The company holds $102 million in cash and carries no debt at all, a high-margin, recurring revenue software business funding itself entirely from its own toll receipts. No leverage required. Here is the takeaway we keep coming back to on this channel. The market will always pay up for narrative, for the next big platform, for the consumer brand everyone is talking about. But the businesses that quietly mint shareholder value for decades almost never look like that. They look like Jack Henry, mission critical to a customer who cannot easily replace them. Pricing power that compounds with inflation. Cash conversion so clean the company does not need debt. And a market structure, in this case a three-way oligopoly controlling 75% of American bank cores, that no startup can credibly attack. Quiet, durable, essential. That is the formula, and Jack Henry runs it cleanly. 7,500 community banks, 99% retention, 17 new wins in a single quarter, the best in 7 years. $2.375 billion in revenue, growing every year. Zero debt. This is the kind of business we build the entire quiet monopoly channel around. The ones hiding in plain sight, charging tolls that never stop, on infrastructure nobody can rip out. If you want more of these, hit subscribe. We find them so you do not have to.